Banks, certified financial planning professional and small business coach based here in Austin, Texas. Welcome back to your financial therapy for the week, and welcome to 2026. This is the first episode to air in the new year, and it's going to be a doozy. We've been off for a couple of weeks and have played some holiday replays. I hope you guys have a chance to listen to those. They're our most popular and kind of fundamental episodes, so I hope that you take a listen and were entertained over the break. But today we are kind of diving back in with a super meaty topic. I think it's affecting a lot of people. We had a current events episode a couple of weeks back, right as the government shutdown was ending. And, just a lot of the feedback from my community, from communities that I work with, is things are really, really tough right now, obviously difficult. And so, how do we kind of navigate some of these really, really difficult times and feelings and do it hopefully a little bit together? And so this episode is appropriately titled, I think, Drowning in Debt. And I want to talk a little bit about the affordability crisis in America. It is a real thing, and people feeling it, I think, need to understand that they're not making it up in their minds, that this is not some sort of, what's going on with them, that they could be buying and affording X number of new toys and things like that. I think even the people who are accustomed to spending freely are really feeling the crunch of higher interest rates, higher prices, inflation, and just the general inability to find financial stability these days. It's no matter what your income is, unless you're making millions of dollars, and even sometimes then you're still chasing that next level. And so let's talk a little bit about what chasing that next level actually looks like in the form of debt, because Americans are really, really in debt, and we've gotten even more in debt over the last several years as the pandemic has passed through, and as things that were in place to ease the pain, like lower interest rates, have kind of been eliminated. And so even though the Fed is lowering interest rates, they're not getting low enough, fast enough to compensate for all of the ways that Americans typically spend. And so that means we've got to adjust ourselves. So this episode, Drowning in Debt, is going to kind of give some basics around debt management, how we think about debt, and hopefully give you some things to chew on so that you can start thinking a little bit more about how you spend your money, what you spend your money on, and what you're willing to go into debt for. So affordability in America, that's become the new buzz term. I think everybody kind of gets that we're in a tough spot. But there are two ways to pay for things in this country, and really around the world, but mostly in this country. You see cash or credit. There's no bartering, limited bartering. The acceptable ways that everybody understands to pay for something is cash or credit. Cash being that you actually have the cash to pay for something. Not necessarily cash like I have, $10 bills in my hand, but cash as in you have the ability to pay for something in the short term from your bank account, from dollars that are actually available to you. It's liquid money. Credit is, of course, when someone, a lender or a retailer, someone extends you credit in order to pay something off over time. And credit in U.S. history evolved from very informal, trust-based loans between merchants and farmers in the colonial era to a more formalized, regulated system involving banks and credit cards and things like that in the mid-20th century. And so the development of things like installment plans or credit from a retailer, all of that started kind of in the 1920s. And then the government expansion of credit during the Great Depression, and then the modern credit card is the mid-century kind of invention in the 1950s. So that made credit accessible to ordinary people. In the beginning, you didn't have access to credit unless you were known and understood as creditworthy. And that meant a very exclusive few. So the expansion of credit to the masses, so to speak, is a relatively new thing that has kind of accelerated in the last several years. And why this matters is because we fuel our consumption with debt. And it's not necessarily a bad thing to have long-term debt, right? Strategic debt, like a home mortgage or a car loan. Those are things that or school loans, health care expenses that turn into payments, things like that. There are legitimate long-term debts that you could incur or that you actually do want to take on. You could have a whole argument about whether or not financial freedom means the ability to own a house or the ability to never have a mortgage payment. Those types of things are part of that whole debt conversation, that long-term debt conversation. But I challenge you to find a single financial planner, advisor, professional who understands finances, who would counsel you to keep short-term debt at any point during your financial life on the books. In other words, if it's something like credit card debt or something that you should or could be paying off within a year, that is short-term debt, and that you should hopefully never be paying significant interest on, because the whole goal is to build your creditworthiness while not paying for the privilege of that credit. Long-term debt, it's almost impossible to avoid paying some level of interest for access to that credit. So I want to separate those two things. Short-term debt and long-term debt are kind of two different categories. And the more that we focus on short-term debt as kind of the thing that you want to avoid, the more I think that this conversation makes sense. So credit is very accessible to ordinary Americans. It's even more accessible these days. Lots and lots of websites or places like that, if you check out, you can have a payment plan for whatever it is that you're looking to purchase. That's all debt. And if you look at what they are charging you in interest to have that debt spread out over time, it can seem very small, but in reality, those things are just picking away at the affordability of future things for yourself by essentially going into short-term debt with those purchases today. That also applies to credit cards. It really applies to anything that is a consumer-focused thing that you are putting on a credit card instead of paying cash, whether that cash is actual cash or a debit card. And so the average American household credit card debt was approximately $6,849, $68.50 in 2019. The average credit card debt per household today in 2025, this is the end of 2025 as I'm recording this, but early 2026 is anywhere from $9,326, $9,300 to $10,900, so almost $11,000. And that increase from $6,800 to almost $11,000 in household debt, I think is a direct reflection of the lack of affordability in the country, because what we're doing is, instead of having the money to actually spend as we would typically spend on our budget, or adjusting our budget to the current reality, many of us are just spending more on credit cards and essentially mortgaging a bit of our future in order to pay for, in some cases, basics right now. But if they're not basics, let's say they are discretionary expenses, that's what we're here to kind of talk a little bit about today. I want to make sure that as we're talking about debt, that we're not shaming. We're not saying that you shouldn't be spending on these things that make you happy, that make your life happy. But it is great to be conscious of debt, how you're spending, and how even the little things that you are spending on right now in this environment can affect your future creditworthiness, ability to spend or have additional money to spend, discretionary income. And, thinking about that, just being conscious about that, does help you to kind of shift your focus potentially to not spending when you know it's going to cost you disproportionately more in the future. So what can you do to stay conscious? I came up with 3 things to keep in mind about debt and spending. And the very first thing really focuses on this credit card short-term debt situation. Anything where your payment plans or your pay over time, that sort of thing comes into effect. That's short-term debt. And unless it is a purchase that you have built into your budget, meaning it's something that you have the cash to immediately pay back, my argument is you maybe should adjust your budget to not spend it. If it is in your budget and it's something that you can afford, it's very important to stay on the budget, because any extras that go beyond what you've actually budgeted can cost you big time. So on credit card statements, I forget when the law was actually passed, but not more than 20 years ago, they kind of regulated credit card statements in order to provide some consumer protection for people who have credit cards and are paying off of that debt. And so if you look at any credit card statement now, they have what you would pay if you paid just the minimum payment, and then what you would pay if you needed to pay off your debt in 3 years. So if you just pay the minimum payment, it'll tell you, okay, here's where you get over time. And if you pay this slightly higher amount, here's where you would get over time. Typically 3 to 7 years, it'll show you how much more or how much you would be paying on that income, or I'm sorry, on that debt over that time. So in other words, I pulled up an example so that I could get real specific, because I want you guys to hopefully go and take a look at your credit card statements, because this is information that is supposed to help you make different choices. But I think a lot of people just kind of bypass it and see it as numbers and go about their business. So I really want to highlight this idea. So if you have a balance of, say, $1,000 and your minimum payment is $25, if you just paid the minimum payment, if you make no additional changes using the card, and each month you pay just the minimum payment. So that's key. That means you pay the minimum payment, but you stop spending. You do not spend a dime over that $1,000, right? So if you just pay the minimum payment and change nothing else, which we all know we're spending on those credit cards over the course of 7 years. So you'll pay off the balance shown, that $1,000, in 7 years, but you will end up paying an estimated total of around $2,000 in order to cancel out that debt. So let's practically think about what that is saying. That is saying I have a $1,000 balance on my credit card. I pay $25 per month over the course of 7 years. And I finally pay that $1,000 debt off only after doubling what I've actually paid because of interest. So I pay $2,000 for that $1,000 today, and I can't spend a single thing more. So whatever coffee or groceries or movie tickets or whatever it is that's in that $1,000, I have spent enough of that for 7 years in order to satiate me and never spend again. That's what we're up against as far as a minimum payment situation. If, however, you pay $43 instead of $25, so, you're upping the minimum payment, but you're still kind of just making tangible process on this $1,000, you could pay it off in 3 years, but you'd still be paying $1,500 instead of $1,000. So obviously, these interest rates are based on, honestly, my credit card. So it can be even worse, honestly, if you have a super high interest rate. I don't know what this one is at, but, typically you're going to be in the 10 to 20%. If you have a good credit score. I've got a good credit score. You could be up to 30% interest or more on some of these cards if you do not have a good credit score, if you haven't asked for them to lower your interest payments or whatever else. So you are either increasing by 50 to 100% of what you're paying. You can't pay anything else, or you can't spend anything else as you pay it off, and it's going to take you 3 to 7 years to actually pay off that debt. And so the practical numbers on that say, well, obviously, I need to pay more than the minimum payment. But I don't think people really recognize the impact of that. So that's why, unless you are spending, getting your points, getting, whatever else from the credit card, and then immediately paying off your balance in full, and you have the money to do that, we should really think deeply about how much we want to mortgage our future spending. How much do we want to never have a latte again just to make sure I get rid of this debt? Higher interest rates across the board mean that you absolutely cannot afford to pay a premium for everyday items. The average interest rate on U.S. credit cards is high at around 21.4%. I mentioned you could see upwards of 30% depending on your credit scores. And so that means that for every month, the average American household balance of around $10,000 that remains on a card, your family is paying about $175, $200 in pure interest. Just pure interest. And so $200 a month, obviously, can be spent on other things. So the premise of, okay, I'm going to spend this money and I'm going to make the minimum payment, I'm going to pay it off and everything like that, you're just piling on more as you go. So $200 a month in interest payments that could be spent on some sort of something is just kind of digging the debt hole even further. $200 is not an insignificant amount of money. And so if the average household is just literally giving that up for the privilege of holding a balance on their credit cards, that is very problematic. I am hopeful that that $10,000 average that American households currently have on credit cards is actually being paid off every month. Because as it's reported to credit agencies, it doesn't necessarily mean that that balance is not being paid off every month. So that's the goal, is nothing spent on a credit card that can't be paid off immediately the next month in order to avoid interest. It's not always possible, but that is the goal. Not the minimum payment, not even a little more than the minimum payment, but not paying any sort of interest or fees on that access to short-term credit. So $200, that's a trip to the grocery store, gas for the month, and instead you're paying for the privilege of being in even more debt. So if you're charging groceries, clothes, living expenses to credit cards and not paying off the balance each month, and you don't have a plan to do so, don't fool yourself. You have to adjust your lifestyle to match what you earn, or get help to start paying off your debt. So even the idea of consolidating your debt and paying it off at a lower interest rate, those things are viable options. But if you're not stopping the descent into debt, if you're not conscious of what all of those little spending things, those lifestyle spending things are actually meaning for your future, then paying off the debt is just going to lead to more debt in the future, right? So we're having to shift our mindset a little bit to say the budget comes first. What I can actually afford in spending in cash every month, that's what I should be working on or working from, versus looking at my credit limit or my credit score or what debt I actually have access to. Okay, so the little things do matter, and we don't want to get to a point where we are paying $20 for an $8 cup of coffee eventually. That's the goal. So the second thing that you can kind of think about in order to stay conscious about debt is that time is money. And time is a finite resource too. So getting into debt for something that is going to then mean you work more, you spend more time worrying about your debt or about what you need to pay for something, that is a burden, a sense of financial burden and obligation that might not be necessary. And so let's as a country not let this new frontier of affordability or lack of affordability become time that we take to pay off our debt, where we're adding more time to pay off our debt. So it applies for the credit cards, certainly the short-term debt, but this applies for long-term debt too. And you know, when we did our current events episode, one of the things that I highlighted was that, oh my gosh, there are so many more cars being repossessed this year and 2025, where it's clear that people cannot afford their car payments as they normally would. And that naturally ends up stretching out loans. So I was reading something else that was talking about the 100-month car loan, which is, upwards of 8 years of car loan. I've talked before about 10-year car loans, those becoming much more common just so that people can afford those monthly payments. And with new cars topping $50,000 on average now, that is real time that you are going to be spending actually paying for a vehicle that may not actually make it to its 8-year or 10-year loan mark. So time is money, and it's really important to pay attention to how you're utilizing the time part of your longer term loans. So, for instance, I know that there's been a lot of floating of 50-year home loans. And that is, of course, to lend itself to more home loan affordability. 10-year car loans, also becoming more commonplace. But if you took a loan out for a $500,000 family home, which honestly in Austin would be a steal in just about any neighborhood, but the difference between paying for that home at 6% interest over 30 years, where you'd end up paying a little over $1 million for the life of the loan, versus 6% over 50 years, is $500,000. In other words, you would end up paying about $1.58 million for that same $500,000 house over 50 years. And for 50 years, you would have the burden of that loan and or trying to exit that house with some sort of payoff, right? You would pay $1.58 million for that house versus 1.08, so $500,000 more if you had a 50-year loan versus a 30-year loan. And that doesn't seem like a lot, maybe, I guess, because it's just kind of like, okay, well, I have a longer time to pay it off. But you're sacrificing 20 years of your life and literally paying for the house a whole other time in order to reduce the daily, or the monthly payment, your monthly mortgage payment, to a degree for affordability. And the kicker is your payment would only be about $350 less per month. So $2,600 versus $3,000. $2,650 versus $3,000. And so the freedom that you're sacrificing over those 20 years, the $500,000 in additional payments that you would be making, and the idea that you're not necessarily even getting that much more in affordability from it, is something that we all need to be thinking about. So maybe instead of stretching your loan to 50 years, our new goal is, how do I make an additional $350 per month in order to cover this cost? And that's with a huge purchase, a home. So that $350 a month for a home is if you've got $2,650 to pay for your mortgage, paying $3,000 is a stretch, but it might be a stretch that's worth it to save yourself those 20 years of additional payments, right? And that $500,000 of additional money that you would be paying, that you could be putting towards retirement or something else that makes you more free, instead of stretching that obligation out even further. So it really is sacrificing some future financial freedom for a tiny bit more affordability. And so looking at that concept of time being money, time being future freedom, is super important. And so if you've got some sort of a long-term loan coming up, question whether or not you should be stretching that out to the degree that you could, or if it makes more sense to pay more upfront so that you can release yourself from that debt sooner. The 15-year mortgage was very in vogue for a while. I don't know that people honestly can afford to do something like that, but you can certainly try and stick to those more traditional 30-year fixed mortgages, or for a car loan to something that's less, 6 years or less. Even though affordability might be a problem, I think that's the signal for us to wonder whether we can actually afford it or not. If you are not able to pay down the debt in some sort of a reasonable time and not stretch that out to such a degree, it should, I think, trigger that notion of, is this really something that I want to or can put in my budget? Or am I making it affordable by trading time and money? Okay, so the third thing that you can kind of think about when it comes to debt, and just being more conscious about how we spend, is to guard your creditworthiness like the gold that it is. Your current choices can literally change your future. So paying your bills on time, keeping track of your credit score, keeping track of your debt to income ratio, which hugely affects new loans, especially home loans, and what all of those numbers mean for you when taking out a loan. Knowing and understanding those things is super important. So I mentioned seeing car loans at 10 years is kind of surprising to me. When I last bought a car, a 5-year loan was pretty standard. And I think I pushed mine to more than that, like 5.5, maybe even 6 years, to get a more reasonable payment. But that was also at a lower interest rate, where it did not have as much of an effect as the 1-2 punch of much higher interest rates these days and much longer loans. So with extraordinary interest rates, longer term loans, it just means the usefulness of that car or whatever it is that you've gotten that loan for is unlikely to last beyond the time that you're actually paying for it. Especially with a car, if a 10-year loan was because you were having trouble qualifying for a loan in the first place. So this idea of protecting your creditworthiness like it is gold is super important, because it is a horrible downward spiral. If you start out with bad credit, you get poorer terms for your loans, you get higher interest rates, your payments are higher. It triggers kind of a downward spiral, or can trigger a downward spiral of affordability, because it's essentially putting the burden more on people who can't afford something to then afford more and more and more based on interest and creditworthiness alone. So the average car loan interest rate is 6.8% for new and 11.5% for used. I can't even believe that. 11% car payment on a car payment is just outrageous. And I would imagine that is only happening if you, like I mentioned, are already having trouble with your credit. So it's a horrible 1-2 punch. The lower your credit score, the higher your interest rate. So that $50,000 average new car, which again, that's average with all of the upcharges that are prevalent, the tariffs, things like that in the current consumer market, at a relatively low 5% interest rate. Like if you had immaculate credit and you just walked into the dealership and there's no deal for interest or anything like that, and you signed a deal for a 5% interest rate, that $50,000 car would run you about $800 a month. For a more traditional, but still pretty long, 6-year loan. So those numbers again, $50,000 car, 5% interest rate, 6-year loan, that's $800 a month. That's pricey. there aren't many people who can just agree to spend $800 a month on a new car. That's a choice. That's a budgeted choice. You're going to feel that, is my point. If you had to get that same car at 11%, because for whatever reason your credit score is not great, you have a high debt to income ratio that makes you a risky credit source, or a risky credit for a lender. This is boosting you all of a sudden to $950 a month to get that same payment, to get that same car, rather, at a different interest rate. So to get that same payment down to where you would be at $800 a month, you might extend the loan to 10 years. You might purchase a lesser car, right? Something that's not new, but that is going to potentially have more problems, more maintenance, more things like that. So let's say that you did get your payment down to a more manageable $700 a month. Those extra 4 years, from 6 years to 10 years, also means you're pouring another $13,000 into the car via payments. You have a lot more maintenance fees. You might have some trouble in those 4 years, like an accident. Even leading up to that 6-year loan, you could total your car. All of that means you are at a higher risk of getting that car repossessed, totaled, losing what you've already invested in that vehicle, while still owing money on a car that has objectively lost all its usefulness for you. So your credit worthiness, your ability to get something that you can afford at a price you can afford, at a lower interest rate, all of those things matter. And the difference between a car payment at $800 a month and a car payment at $950 a month for the exact same car, just the only difference is that the interest rate is higher because you aren't as credit worthy. That's something that can obviously cost you. $150 a month is a lot of money. And again, groceries, clothes, living expenses, bills, utilities. There are myriad things that you could be paying with $150 a month if you have the credit worthiness that gets you that lower payment amount. So thinking about these 3 things, being conscious of what these 3 things mean. First, the little things do matter. Short-term debt is short-term debt. It is meant to be paid off immediately. If you're not paying things off immediately and you're spending on your credit cards every month, just recognize that those little expenses are costing you in the future. The average American household has $10,000 worth of credit card debt, and that's $200 a month just in interest payments if you're not paying that debt down every single month, paying your balance off. Second thing, time is money. Don't think about extending a loan as creating affordability. Think of it as further draining your payments. You're draining your future income based on paying for a longer term loan. And that can get pricey. That can get very pricey as far as the interest that you're paying on top of itself versus what it actually buys you in affordability. If it doesn't really buy you a lot in affordability, make sure that you're watching the time of those long-term loans, because that is super important to future affordability and future use of those dollars. And the last thing is to guard your creditworthiness like the gold that it is. So paying your bills on time, making sure that you actually do what it takes to where when you go out for that loan, when you go out for whatever that debt that you actually need is, you will get the lowest interest rates you can. Your payments will be hopefully more manageable just because you have been a good steward of your credit worthiness. So I hope this is helpful. I think that it is really just a tough time, as I said. And, one last thing I'll mention is that it may get tougher out there. Until recently, I was reading that a lot of companies have been really trying to eat the tariffs and not pass through a lot of costs through to consumers. And according to Goldman Sachs, we only have felt about 50% of those costs, about 55% pass through of those costs. So there are likely to be more affordability issues in the future. And I think that just lends itself to really having this conversation with yourself. Is this a purchase that actually fits into my budget? And if not, how can I make it fit into my budget? Am I extending myself, mortgaging my future? And am I doing everything I can to be credit worthy so that when I do need access to that credit or some sort of a debt, I can get access as cheaply as possible. So hope this helps, guys. I will be back next week with another episode, goody, talking more about finances, money, and the situation we're in today. So thanks, guys, for listening in. If you enjoyed this episode, please like, subscribe, and give us a review. All right.